in this chapter, we asked questions for important ratios. How could we improve it? And we wanted to go back to grammar school and just look at the ratio and say, how could I make this ratio bigger? I could increase the numerator or I could decrease the denominator. So for ROE, what does that mean? If we increase the numerator, we're increasing net income. That would clearly be an operational strategy. We're trying to improve our operations. We're trying to increase our sales and reduce our operating costs, okay? If we decrease our numerator, what are we doing? Our denominator, what are we doing here? We're decreasing our equity. We're doing a debt for equity swap, right? And that could be like a leverage buyout or something like that. And that would be a financing or a financial engineering type of strategy. And again, remember in finance, if you can make it so algebraically, it's either been done, it's being done, or there's a financial engineer working at this moment who's going to try and make it so in the future. All right. And then we got into leverage, extremely important, right? We are going to keep coming back to leverage throughout the semester. So we spent some quality time on this, extremely, extremely important. So we had two types of leverage, financial leverage, which is all about debt financing. I think the best way to measure it is debt financing versus total financing, or debt over some measure of income or cash flows. Operating leverage, very different, very different cause. Okay, operating leverage comes from having more fixed costs than variable costs. Okay, and we talked about what fixed costs are and what variable costs are. So the causes of operating leverage very different than financial leverage, but the result is the same in both cases. More leverage, better results for owners in good times, better ROE for owners in good times, more risk of bankruptcy in bad times. Okay. Um, and so that's what I've got written down for us here. So their leverage ratios, now we're a little bit too complex for just bigger is better. Our leverage ratios are measuring upside to owners in good times and risk of bankruptcy in bad times. Okay, and financial leverage we looked at first. That's the most common because it's easy to get from the GAAP financial statements. And we looked at two examples for this. We looked at the conservatives versus the cowboys, and each group had 100 million dropped on their heads to invest, and they each went about buying this company, Prefab Home Builders, and the conservatives, the equity here was the firm was for sale for 100 million, equity 100 million, no debt. So they just bought the whole firm. And the income statement looked like this with net income of 15 million, and that was in a good year, and things proceeded that way for a while after they bought it. The Cowboys bought this firm in a different way, okay? For the 100 million that they got dropped on their head, okay, they only spent 10 million of that to purchase this firm. But remember, the firm is for sale for 100 million. So where'd they get the other 90 million? Well, they went to JP Morgan Chase or Bank of China and they said, hey, this is an awesome company. I want you to make the company, not us cowboys, but make the company alone at the moment of the sale of the company, and that 90 million proceeds are going to be used with our 10 million to make the 100 million that we need to buy the company. And that's really great, except now, of course, the company has 90 million in debt obligations that it didn't have before, and the interest rate on that is 10%. So if we go through the income statements now, for the conservatives, the company's running just as it was, didn't have any debt, doesn't have any debt. And for the Cowboys, because of this 9 million, right, we've got less net income. And we don't have exactly 9 million less net income because of the tax shield, right? Okay, so if it was exactly 9, they would only be getting 6 million in net income. So the tax shield has really helped them there. And the incredible thing here is that the conservatives have pretty good ROE, but the Cowboys have this almost scandalous 82.5% ROE. That's really high. That's really high. And you say, yeah, but they only got 8.25 million in net income. Yes, but they still have 90 million, so they can buy 9 more companies like this and get 8.25 net income from each one. So what are they getting total? 82.5 million in net income. That's pretty awesome. And they are diversified. And then we saw what happened in a bad year, however, because they got to pay this interest. It's a contract. They might be in big trouble with their earnings before tax and their net income. And if they don't have enough cash on hand to make this interest payment to JP Morgan Chase or Bank of China, they've got to either declare bankruptcy or turn over the keys of the company to the lender. Okay, so you get awesomely great results with leverage, financial and operational in good times, but it really increases your risk of bankruptcy in bad times. Okay, so all of these key takeaways are summarized for you here. I'm going to let you read those on your own. Okay, we've got the 2 pages of takeaways there. You should review them. I'll let you review those on your own. We have actually 3 pages of takeaways here, so check those out. Then the other example that we looked at, and you can count on one of these examples, either a private equity type or a capital budgeting type. We looked at thinking about buying either 1 unit here or 2 units here and doing a gut rehab and then selling. We happen to have enough of our own cash, that would be our equity investment, to buy 1 unit. So if we want to do this for 2, we're going to have to take out a loan to get us enough money to buy both units. And we compared those. We also had an in-class example on this. So there's the buy 1 unit option. That's no debt because why? We have a capital budget of 100. The building is for sale, half the building for 70, plus our gut rehab costs are 30. So that's where our 100 comes from. Or what we could do is buy 2 units, in which case we'd have to take out a loan for 100, and our total capital budget would be 200, and we'd have 50% equity capital budget and 50% debt capital budget. And then we just work our way through. So if we buy 1 unit, it's 70,000, 2 units, 140. The gut rehab costs for 1 unit are 30, 60 for 2. If we just buy 1 unit, we're doing this with our own $100,000. We have no debt, but we're going to have to pay 10% interest on this $100,000 loan otherwise. So that's $10,000 for our levered $100 loan option. We think we can sell each unit after we've done the gut rehab for 125. That's pretty cool, from 70 to 125. If we have 2 units, we'll be able to sell each one for 125, get 250, work that through, and you see that we get much higher net income in this case if we do 2 units and much higher ROE. It's not twice as much, of course, because we have to pay the interest. And of course, it's way riskier to do this, right? Because if things go wrong, really badly wrong, we lose our 100,000, but also now we have a contract that we have to pay back. So you can always lose more money in a situation like this than you put in. Okay, so of course it's riskier to go with leverage, all right? Okay, and then operating leverage, as we say, measures fixed costs to variable costs. And for us, we're going to say fixed costs are costs we can't eliminate in a quarter. Okay, in general, they're costs that don't scale with small or medium increases in sales. Variable costs are just the opposite. These are costs that scale linearly with small or medium increases in sales. And we're going to say they're costs that could be eliminated in a quarter, just to keep things simple for us. That's a little artificial, but I want to keep it simple. Okay. And so operating leverage, like I said, very similar in effect to financial leverage, higher operating leverage, better returns to owners in good times, but more bankruptcy risk. Okay. And they're not completely independent because interest is clearly a fixed cost, but it's also related to financial leverage. And then we went through West End and the Carpenter. Neither of them had any debt, so we were able to remove the financial leverage from the picture for this one. And we saw how in a good year, even though the Carpenter has a bunch of variable costs and West End does not, that their net income was identical. But in a bad year, the Carpenter's variable costs get reduced, and West End has nothing but fixed costs, so our costs are not reduced at all. Okay, and you'll see she does much better than us in a bad year. She has double basically the ROE than we have. And in a very good year, however, we've got this beautiful thing that even though our revenue goes way up, our cost structure has not increased. And this is how Bill Gates became the second wealthiest person in the world. Microsoft, when he was running it, had a very high fixed cost structure, almost zero variable cost structure. So in very good years, the revenue of Microsoft would just crank up, almost no variable costs. So that would drop right down to the tax line and to profit. So with the carpenter, as she does more work, she needs to buy more nails, buy more gas for a truck, buy more sheetrock, all that stuff. Her variable costs go up, and so she cannot keep up with us in the ROE department. And this never is going to be true forever for any firm. If the carpenter gets 200 hours worth of work a week, what's she got to do? She's got to hire someone to work for her, and that's going to be a fixed cost, paying that employee and the truck for that employee and things like that. Okay. Um, and here are key operating leverage takeaways. I'll leave you to read those on your own. They're pretty much what we just talked about. Definitely read these over. Okay, and then finally, our last ratio analysis method was liquidity. Okay, and we had our general important definition of liquidity. It's a measure of a firm's ability to quickly produce cash to meet potential or certain short-term obligations. And we also looked at a more specialized real-world example. One of the 20 biggest in the banks in the world collapsed in the Great Recession because it was not liquid. It thought it was liquid, but it wasn't, because nobody would buy the junk they had for sale that they thought they could sell. Okay, so our liquidity ratios are always measuring sources of cash versus cash obligation, something like that. Bigger is better to a point. Always to a point, because if you have too much cash, your shareholders get pissed off. They're not investing in you to create the mother of all piles of cash, and they'll start saying, hey, you need to dividend some of that pile of cash back to the owners. And usually they win that fight when they start fighting that way. So what are our sources of cash? Current assets, we know what those are from accounting, or working capital assets. Cash flow from operations, right? That's generating cash for us, hopefully. We talked about revolving lines of credit. Those are like a credit card for a company. And the obligations, current liabilities or working capital liabilities. If your operations are burning cash, you have to put cash into them. That's a cash obligation. Remember, GM's operation had to put $5 billion into their operations to make all their cars and trucks per quarter in 2008. That's not good. Interest is clearly an obligation. Depreciation is not, but CapEx definitely is. CapEx is maintaining and increasing as necessary our property, plant, and equipment. So for Love and Southwest, that would be maintaining primarily their planes, replacing the tires, replacing the engines for the flaps, replacing anything that breaks. That's all CapEx. So we talked about what CapEx is, need to know what that is, need to know where to find it, and it's on the cash flows from investing portion of the cash flow statement. And we talked about working capital. I'm not going to ask you to compute a working capital ratio. We talked about why not in class. It's really something you can't do algorithmically. You usually have to go to the notes to the financial statements, but you definitely want to know what working capital accounts are. So here's a definition. What do you do when you see a definition? You memorize it. So you need to know, you need to have memorized that definition and see how that all plays out down here. And we've got, once we know what working capital accounts are, we also need you to know the definition of working capital. This comes up in finance every day, basically. So you need to know that definition, and I've got it described for us here. And this one, even though it's not a definition, a ratio, we can talk about it sort of like it is. Bigger is better up to a point, and negative is never good. Okay. And we talked about EBITDA is just like EBIT, except now we're also excluding depreciation and amortization, if any. How do you know if there's amortization? Well, if it's on the income statement, you got it. And if it's not, then you only have depreciation. And if there's no depreciation, it just means you don't have any PPE, so it's not wearing out. Okay, so yeah, if your EBITDA, if your earnings before we pay interest or taxes or register our depreciation or amortization, if that's not greater than zero, you really just give up. Okay, and then we talked a little bit about our alternate framework, the DuPont identity. You do need to know this too, okay? And instead, the DuPont identity, instead of looking at our 5 various ways to think about ratio analysis, it thinks about 3. So this is the key equation for the DuPont identity. It just takes the definition of ROE and in a cute academic-y kind of way expands it into net income over sales times sales over assets times assets over equity. So you see the red cancels with the red, the purple cancels with the purple, and you're wound up back again with net income over equity or ROE. So what does this mean? It means it's thinking about 3 components. Clearly, that first one, net income over sales, is thinking about margin, specifically profit margins. It's thinking about efficiency ratios. This was the first efficiency ratio we looked at, sales over assets, our asset efficiency, and it's looking at leverage. It's looking at it in a way that we didn't look at it. I don't know anyone in the real world that looks at leverage this way, but I guess some academics do. So they're measuring leverage by assets over equity, where we've been measuring it by debt over debt plus equity or debt over assets, something like that. If you measure it this way, it's called equity multiplier. Okay. So what's it ignoring? Well, it's ignoring a lot of the ratios we developed, and it's ignoring sales and sales growth and liquidity entirely. Okay, so that's the story there. All right, and that's it for 6A. Let's move on to 6B. And in 6B, we wanted to do 2 things. We wanted to improve what we had done in 6A in 2 ways. We wanted to introduce a sort of formal risk-reward framework for the first time. We implicitly used this framework in the first class with HCP, but we formalize it here, and that helps everybody. And then the second thing we did in this chapter was we started adding market data to our financial statement information, and that, as we saw, is especially helpful to equity investors. So what else did we do in this chapter? We went over the development of our risk-reward framework, and we broke it into 2 parts, debt investors and equity investors. So in both cases, we've got, you want to think about your reward analysis and your risk analysis. Okay, so for debt investors, it's basically what's the interest rate we're going to receive, assuming the company doesn't flame out. That's it. Pretty simple. And for risk, and this is going to be true for any financial analysis conceptually, what could go wrong? What's the probability that something goes wrong? And how big a loss do we incur if something goes wrong? So in debt in particular, what could go wrong is also pretty simple. It's basically, could the company default on the loan or bond contract? That's about it. That's about all that can go wrong. But these 3 questions are going to be for any type of financial project. Okay, then we went to equity investors. Okay, and we reward for them depends on what type of what you're looking for as an equity investor. If you're looking to buy the stock at a low price, sell at a high price, then that's your reward. How much is it going to go up after we buy it? And if you're a more conservative stock investor, you're buying the stock maybe to get dividends, and you're hoping that the stock price doesn't go up or down, well, at least down too much. So you're saying, how big will our dividends be? And for risk, again, exactly the same conceptually as for debt investors. What could go wrong? What's the probability something goes wrong? And how big a loss are we going to incur if something does go wrong? But specifically for stock investors, what could go wrong is the stock price could fail to go up, or it could go down instead. That would be bad. And what if the dividends are reduced or stopped altogether? That happened to firms that had been issuing dividends and always increasing their dividends for as much as 80 years, stopped issuing their dividends in the Great Recession. And that was bad for a lot of people that were counting on that. But for the companies involved, was there any problem with that? No, because dividends are not contractual obligations. They can stop paying their dividends whenever they want to, and a lot of them had to in the Great Recession. All right, so then we said if we're going to do this stuff to add our market data, this is going to help equity investors. So we wanted to know who are our beautiful equity investors, and we looked at three major types of investors: value investors like Warren Buffett and Merrill Whitmer, and they're doing their analysis with a risk-reward framework, balance sheet valuation, or DCF methods, discounted cash flow methods, which we're going to learn later on. Second up, we're relative value investors, and they're asking things like, is the company going to outperform its peers? And they want to find the best company in an industry or a group, and maybe the worst also. And they're going to buy the best and maybe short the worst. And I gave the example of the folks running the Harvard Endowment, and they would try to buy the best two or three companies in an industry, short the worst, and they made money in almost all conditions as a result because they were good at making those estimates of who's going to be best, who's going to be worst in this industry. And then, as I talked about, because of the spread between best and worst, they made money in almost all circumstances. So they're always also, they're going to start doing all this through a risk reward framework, and they're going to use ratio analysis with market data, which was the subject of the rest of the chapter, or DCF methods, which we're going to learn later. And finally, other big bucket of investors are growth investors, and they're just asking, is the company going to grow sales and net income more quickly than sales? Beautiful example of that over the past year is Tesla. Tesla had no net income a year ago. Its sales were growing. Its sales started growing a lot faster when they moved into China. They came out with the Model 3 and they became net income positive, and their stock price has just gone parabolic. It's just exploded. So that's a classic growth investing story. In my opinion, not enough risk reward framework for people investing in Tesla right now, but the professionals are doing that. And what are they doing? Ratio analysis with market data, which we're learning about in this chapter, and DCF methods, which we learn in future chapters. Okay, so we're really going to be focused on, in this chapter, relative value investors and growth investors and helping them. So then to start doing investment ratios with market data, we wanted to remind ourselves of the three measures of equity: GAAP, market value, and intrinsic value. And why did we do that? Because really what we want to do in this chapter is just replace, mostly we just replaced equity GAAP with Mr. Market's view of the equity. Okay, and that was actually quite a good thing. Mr. Market may be right or may be wrong, but Mr. Market is probably an awful lot closer to the estimate of what a company is worth to its owners than GAAP equity, which is just this weird assets at cost minus liabilities. It's just not very helpful. So we went through and we got some market data for UAL. To do this, we need the market data. All we need, we don't need much, is shares outstanding and price per share. And from that, we can get the equity just by multiplying those two together, equity market value. And then we could go through and do our ratios. So we did ROE market value, just like ROE in the previous chapter, except now we're using equity market value. We learned a couple of new ratios. We learned the PE, which is very similar to ROE. It kind of looks like 1 over ROE, and the difference is the timing. For ROE, we always want equity beginning of period, and for PE, we always want equity end of period. Otherwise, they pretty much are 1 over each other. Okay. And PEG ratio we didn't bother with. Again, I have these things all here for us because we do use them actually in the office, but you don't need to know PEG. It's a gray page. Don't worry about it. We did talk about dividend yield and payout ratio and debt to enterprise value. That was our analog for debt to capitalization, except now instead of using equity gap, we're using equity market value. When we do that, we're using down here the enterprise value instead of capitalization. Okay, and that was helpful. We talked about why that was helpful. If I'm a kind of shady character and I buy a firm that is capitalized with debt and equity, the lenders from the debt part of the capitalization, they have the right to say, we don't like you as a new owner, so we're making all the debt due and payable the moment you buy the company. So really, I can't buy the company just for the price of the market value of the equity. I've also got to pay off all the debt or find another lender who will refinance that debt for me. So enterprise value is important for that reason, among others. Okay. And then I showed you here for all these numbers, we didn't do it in class, but I showed you exactly how to compute all of these numbers, okay? And I only did TTM, so hint, 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 I'm not going to go crazy with these ratios on the exam. I think I've said in class we've got about 5, maybe a couple more than that, ratios to compute from 6A, and maybe 3 from this chapter. And equally important or more important are going to be the questions about what these ratios mean. Okay, yeah, so we did look at some questions, and then down here I've got, just to help us out, I've got all of the financial statements, so you can just stay in this condensed version of this handout when you're computing these numbers and just refer to, you can refer up here to get the market data, and you can refer to down here to get the information you need from a balance sheet or income statement or cash flow statement. And that's about it. That's about it. In one sense, it seems like a lot that we have covered. In another sense, conceptually, hopefully it all sort of hangs together and is fairly straightforward. So I think if you understand all of the concepts we've gone over here, and like I say, if you can do from scratch every numerical example we did in class, every numerical example in the homework, every numerical example in the in-class quizzes, you should be able to do like really well. Hopefully, if you have done all those things, you're going to do really well on exam one. And I wish you the best of luck on exam one. And that's it for me. Over and out.